Yeah, we start today's market talk. We are seeing with the kind of uncertainty which is there in the world right now, along with various issues related to tariffs, it is time to seize the moment for our country. India can transform this crisis into an opportunity by accelerating long overdue reforms that could make the nation more competitive globally. Bringing reforms would be good as various sectors will learn to be competitive and nation will become self-reliant. We need to accelerate our productivity across agro commodities, increase competitiveness in every sector we aspire to be a globally significant player, and bring in technological partnership with global companies. For that, integration with the supply chains which are prevalent in the world is most important. And this is the opportunity now which has been forced on us by all this tariff talk. So last week was basically related to tariffs and tensions. Now, in my opinion, this is the whatever has been imposed, 25% tariffs and some additional penalties is just a pressure tactic to get India to sign a deal that has big advantages for the US. So 25% tariffs on India is high. Let's not be mistaken about it because the baseline tariff is 15%, which is applicable to most of the nations. In addition, Trump has threatened to impose penalties for buying Russian oil and defense equipment. So if you just go back few days before 2nd April, the average tariff was 3% on India. Then it became 10% interim tariff after that. So 25% is a big shift in absolute sense in and in relative terms if compared with competing countries. See, the basic thing which I was talking about is that the whole supply chains in the world will get reconfigured based on tariffs advantages. So if you are having a disadvantage with respect to your competitors, the FDI or the capital will not flow into your. So it is very important to get a good deal. It is a negotiating tool to ensure market access for sectors like autos, agriculture, and dairy for the US. US also wants India to commit to large-scale purchases of defense equipment, natural gas, and nuclear reactors. Presently, Russia's share in India's oil import has surged to around 28.5% or so, and Trump's objective is twofold: push Russia-Ukraine settlement using sanctions on all people who are importing oil from Russia, and force India to buy more oil and arms from the US. So this is all just a pressure tactic. Let's see where it ends. Now, what is the problem? Problem is India's labor intensive industries are threatened and it could derail the country's growth trajectory. Now, tariffs will pinch specific sectors that are labor intensive and have a bearing on incomes and consumption. Let's take an example, textiles. It employs roughly 4.9 crore directly and indirectly employs many more. A sector has a low labor cost advantage, and now Bangladesh, Vietnam, Philippines, Sri Lanka are beating us even on cost. And while China is beating us on scale. Hence, getting a fair deal and becoming more productive is most important. So what will happen is domestic manufacturers will face severe margin pressure as they will not be able to pass on the increased cost to US retailers, forcing them to absorb a portion of tariff burden, which will impact profitability. Similar issues will be faced by pharma, chemicals, gems and jewelry, aquaculture, auto ancillaries, electronics, leather, etc. All labor intensive sectors. So it is not only one effect of these sectors. There is a second order impact, which will be job losses, which would impact consumption, higher delinquencies for banks and NBFCs because the loans will become NPS, etc. And this is the reason why the markets are correcting. Now, a weakening rupee is not good for foreign portfolio inflows, and we may see a continuation of the selling by foreign investors. So, if you see here, this is the rupee versus dollar. So, if you see the rupee, which had gone up to around 88, had strengthened to around 83.5 or 84 level, is again started weakening in the last few days, and it had hit the level of roughly 87.5 plus, where I think on Friday the RBI had intervened, and then it had come to 87.21. So rupee had closed at 87.21 on 1st August. It's under strain from foreign fund outflows. Weaker rupee makes imports, especially oil, expensive. It may stoke inflation. In addition, the Powell's cautious note, that is the Fed chairman, indicates Fed is not rushing to cut rate, means stronger dollar. Now, stronger dollar means weaker rupee. Further, a further 25 basis point rate cut by RBI by September will help investment and spending, cushioning the economy from external shocks. So if you see, India is having a good monsoon. Inflation is low, roughly in 2.1, 2.2 percentage category. Services, exports, and forex reserves are strong. Hence, there is a scope for further relaxation in monetary policy. Hence, there people are already penciling in a possible rate cut in September, etc. So now coming to we have seen the US dollar. Now coming to FI data and their positioning. So if you see here, they have added short on 1st August. So their net short positions are very high, roughly around 1.58 lakh short positions in index futures. Now the interesting part comes here, where they have sold 76,000 call options, and they have bought 2 lakh put options. So that means FIs are net short in a big way. Now let's see what pros are doing. Pros are mildly bullish on index futures, but here again, they have sold call options. They have bought 2.26 lakh put options. So that means FIs and pros are basically net short on the market. So if you add the put options, it comes to around 4.3 lakhs, right? Now, what the clients are doing, or that is basically the HNIs, they have they are long in index futures, they have bought call options, and they have sold put options. So they are the counterparty to FIs and pros. Now, this thing was already there even last week when I had covered. So last week the markets have come down and FIs and pros have made money while clients or the HNIs have lost. Now the positions have become actually more stronger on both sides now. So we are at a very, very difficult stage right now, and FIs and pros are pushing the market down. Why they are more into buying puts? Because the premiums are low. Hence, it's of no point selling options. It is better to buy puts because it's a easier trade. Now, in addition, so if you see here, FIs have sold in last 30 odd days roughly 45,000 crore in cash, which is roughly $5 billion. So that is again driving the prices down. So from around 61,000 index futures short positions, it has come down to 1.58 lakh. So they are around 10% to 90% long short right now. So it is an extreme level. Short covering can always take place, which took place firstly on 31st July, which was the expiry day. So the markets didn't fall that much on that day when the tariffs were announced, 25% tariffs, and recovered from the lows. But every day short covering cannot take place. And if you see here, the days on which there has been major addition of index short positions in the index futures, the markets have gone down roughly, Nifty has gone down roughly around 1% on each day. So from roughly trading at around 25,500 at the beginning of the month, we have lost around 1,000 points and have come to around 24,500 levels. Now coming to US, uh, what is happening is, US had a very interesting week due to trade developments, weak economic data, and concerns over independence of Fed, where every day there is a threat to remove or sack uh, Jerome Powell. So what happened was on Wednesday, FOMC held key meeting and kept the rate steady. And Powell signaled that policymakers are in no hurry to cut interest rates because they are watching what is the development on tariffs, etc. So the stocks sold off. So on Thursday, the core personal consumption expenditure price index came in higher. So that means inflation, which the Fed follows, was higher by around 2.8% for June. So again, there was no trigger. But on Friday, the non-farm payroll report came. US jobs growth in July was weaker than anticipated, while payrolls for May and June were revised lower by 258,000. So what is now happening is that it's a clear signal that the economy is weakening and there is no jobs growth. So the rate cut odds now move back up to 80% in September. So the markets are now pricing in a rate cut in September in the US because of weak economy. Uh, but in the last week, earnings came strong from Meta and Microsoft, which took the markets up to all-time high, and then Amazon disappointed while Apple was in line. And reciprocal tariffs were reinstated on several US trading partners. Hence, if you see here, US government bond yields last week fell. Basically, it fell on Friday, but it has now come down to 4.21. So it fell roughly, it lost around 4% last week, and from high of 4.3, it came down to 4.21. So the fall in 10-year yield is lesser. The 2-year yield has fallen roughly 20 plus basis point. Now, the dollar index, which on tariffs announcement, because if tariffs are imposed, the dollar becomes strong, was going up. It touched 100 level. Then based on the weak consumption data and the weak jobs data, and the hope of a rate cut, the dollar index fell. So it came down to around 98 level, and it is expected to go down now further. So it fell from that 100 level. So that is another issue. So once it was going up, the rupee was weakening. Now, if the dollar starts falling, there should be some support for the rupee. Now, Brent crude again, based on restrictions which are being put on the Russia for selling oil, and the restrictions which are being put on the nations which are going to buy. So the oil prices started going up, but then on tariffs and the weak US jobs data showing that the economy is weak, the oil prices also crashed on Friday. Now, what is happening is in all this scenario, what happens is that once the risk of trade takes place, the money starts moving into the gold. So the gold was up around 1%. It has now come back up. It had declined. It has come back up above this now, above the rising trend line support it had. Silver corrected because it is a kind of an industrial metal, and if the economy is going to be slow, so the prices fall. It so sold off from after making a fresh high, fell around 3%. Copper also fell. It fell drastically 20% because the Trump changed the tariff-related policies related to copper. So all the copper which was flowing into the US stopped, and the prices fell. As the risk of trade started, so the money moved out of Bitcoin and other cryptos. So the Bitcoin fell around 5%. Now coming to S&P 500, it fell after making a fresh high. It has fallen around 2% based on the weak jobs data. Similarly, Nasdaq fell around 2%, and Dow Jones also fell around 3%. So all of them, after making a fresh high, are correcting. So what is the signal? The signal is that labor market momentum in the US is de-accelerating, and because of that, there is expectations of a rate cut because the economy may go into recession, and the rate cuts take time to get into the system. So the markets, the bond yields corrected by around 20 basis points. Now they are repricing the Fed's reaction. Earlier they were saying that maybe because of earnings are strong and inflation is high, there may not be a rate cut. So, but now they are repricing that a Fed will have to react. Market sentiment has changed, and stocks have reversed from all-time high, as we have seen. Average tariff rate of 15 to 20% means consumption will get curtailed. This will impact GDP, corporate earnings, and equities. Safe haven flows emerged, as you have seen, money moving into gold, and momentum has given up gains. So all the momentum plays like Bitcoin, etc., have given up gains. Bad news is good news trade, which used to earlier take place in the US, because what used to happen is that if the job data is good, the market used to job data is bad, so the market used to go up. That is, bad news is good news because of expectations of rate cut is over, as stagflation risk is back. Slow growth, persistent inflation, elevated rates, high debt, and high fiscal deficit. This is the problem. So the dollar also fell, as I showed you, as money moved to yen and Swiss franc, then dollar. Markets are reassessing its prior complacency because they were complacent that things will be okay, tariffs will not impact, etc. Even if you see our VIX, I'll show you, was at around 10 or 11 level. Positives are AI-based growth and massive amount of liquidity which is flowing globally. So let's see how will the market react. Will they correct or shrug off what happened last Friday? So we'll have to wait and watch. So now what is happening in India? India VIX, which was falling, had fallen to 10, is now started rising. It was up around 4% last week. So that is now they have started pricing in some kind of risk now. Now coming to Nifty, if you see here, it has fallen for 5 weeks continuously and has come down to around 20 EMA on the weekly charts. So if you see, there were two trends. Intermediate trend was up. From April 7th, it has gone up. While for short-term trend, which is stretched now into the fifth week, is down. So the support zones are getting tested. So this is the first support zone where the market had rested for a long time, and then it had moved up. This green candle was basically after the ceasefire was announced between India and Pakistan, and so that is where it moved up. Uh, so let's see what happens. FIs, as I've showed you, are short. Uh, they have short positions which continue to be large. So for any up move, these short positions have to reduce drastically for any revival. Now let's see the daily chart. So if you see from the fall on April 7th to see the complete rise in this part of the move, uh, we have come down. Nifty has come and tested the 100 EMA. So it has clearly broken the 20 and 50 EMA. So after that, this is weak. Now it has tested the 100 EMA, which it may decisively breach maybe on Monday. Once that is gone, the next level of support comes at around 200 EMA, which is around 24,200, or the 38% retracement, which is again at the same levels for the complete fall. So after this level of 24,500, once that's taken out decisively, the next level of support should be 24,200 or somewhere close by, because that is the 38% retracement of the complete fall. So somewhere around these levels, one should be looking to buy good quality stocks. Now coming to hourly chart, so if you see here, it has been declining. Uh, so on 28th or so, after that, it was declining. Then it tried to go up, and then on Thursday there was a tariff announcement. There was a gap up, short covering, but after that again, markets are declining. So once it on hourly charts, it reaches that oversold zone, then they will start bouncing. Similarly with Nifty Bank, 5 straight weeks of decline, but it is relatively stronger as compared to Nifty. Nifty Bank, if you see here, it has broken the 50 EMA, but there is some distance. But I think the once 55,000 level is taken out, then it will become vulnerable because there are a lot of long positions which are there. Now, the strength in Nifty Bank is due to HDFC Bank, because HDFC Bank has not corrected below the 2000 levels. It is holding the 2000 level, which is the 20 EMA. While Reliance has corrected, it is below the 100 EMA and may take support at 200 EMA. Let's see if it happens. Though it is slightly oversold now, so let's see what happens. It had become oversold, then it had bounced a bit, but it's looking vulnerable. Once this 1370 takes out, is taken out, that will take the market to test the 200 EMA for the Nifty. Midcaps tried to make a fresh high but failed. So it has now come to the critical support level. So if this levels break, midcap select, it will go and test the 12,000 level. So let's see what happens. Similarly, with small caps, they are looking more vulnerable. They fell around 3.5% last week. So they are expected to come down further. Now I'll cover two stocks. First is Skipper. It's a leading manufacturer for transmission and distribution structures, towers, and poles. In its engineering product segment, a leading and respected brand in the polymer sector, as well as trusted partner for executing critical infrastructure EPC projects. So if you see the brand ambassador for Skipper's pipes is MS Dhoni. It received new orders totaling around 2,000 crore in Q1 FY26, which included 756-volt transmission line projects from Power Grid in the states of Rajasthan and Andhra Pradesh. In Q1, it has installed and operationalized its first plan of 75 kiloton in line with the guidance and reached a capacity of 375 kiloton. The the company has secured a tower testing and design order of 25 crore from the Middle East's largest utility, Saudi Electricity Company. It is also participating in a wide range of high value tenders across Africa, Middle East, and Latin American markets. It has commenced the development of specialized capabilities in the substation EPC fieldwork. So if you see the earnings this quarter, it was up 15% year on year. The gross profit was up 20%. EBITDA was up 21%, basically because the EBITDA margins improved, and that was a surprise. From around 9.5, 9.6 level, it came to around 10%, and PAT grew around 40%. So decent results, and it was a surprise on the EBITDA margins. Now, as I told you, it has three verticals. The largest vertical, which is around 82% of the total thing, is engineering products, where there was a good growth, 23%, and the margins improved. So they came at around 11.3%. Others, polymer grew 33%, while EPC, or that is infra projects, came down by around 40%. So basically, that engineering part is their key function, 82%. Polymer and infra is smaller part of the business. Hence, overall, it grew around 15%, with EBITDA growing around 20% and margins improving. They do around 5,000 crore of revenue in a year. They have a decent order book, which is around 8,520 odd crores. So which is good. They got decent new orders, and the share of non-transmission and distribution products, including railways and telecom, in the overall order book stands at 14%. Order book is growing consistently. CAGR is roughly 52%. Geographical breakup, if you see, domestic is around 90%, exports is 10%. Segmental breakup, if you see T&D in the order book, transmission and distribution domestic is 75%, export is around 10%, and non-T&D domestic is 14%. So non-T&D domestic is basically telecom, railway, solar, water EPC, and other steel structural items. They have a diverse product portfolio. For engineering, they are making these power transmission tower, monopoles, railway structures, test station, power distribution poles, telecom tower, all these things. Then infrastructure, they do these tower and substation EPC, telecom EPC, coating, water EPC, that they are trying to reduce now, uh, though it had grown. So the engineering segment is growing decently, with they're providing towers for various range of voltages, and export revenue is also increasing. They have increased their capacity also. So their constraint, the critical, last time when I had covered Skipper, I had told that their constraint was capacity, because they were really running at nearly 100% capacity. So now they have added 75,000 metric ton capacity in this quarter, and they are likely to add some more capacity. So that should help. In polymer, they make all these PVC pipes, CPVC pipes, HDPE pipes, fittings, bath accessories, storage tanks, agricultural pipes, borewell pipes, etc. So that is another part of their segment, which is around 10%. So if you see their forward guidance, uh, they are they are doing around 5,000 crore or 5,500 crore in FY26, and around 7,000 crore they are expected to do in FY27, with a profit of around 320 crore. So the earnings should be FY26, they're talking about 20 rupees and 28 rupees in FY27. So, taking a mean of around 24, 25, this stock should easily trade at around 20 to 25 times. So, can easily trade at 580 to 600 levels. Uh, they are talking about 25% growth, 40% net profit growth, and profit margins to around 11%, which we'll have to see that whether they are able to do that, because this segment is very, very competitive. Net asset turnover is good, 1.6 times. ROE is improved, and debt is reducing. So these are all good. So what they are talking about is 20% revenue growth, 30% profit growth, and 20% ROE, which has to be achieved. Right now, the ROE is low. So let's see if they're able to achieve that. So now, if you see this stock, it had corrected from a high it had made, and then uh, the prices were declining because they were not having adequate capacity. Now it has rebounded, broken through this declining trend line. So if this sustains, it has broken through on Friday with large volumes. If this sustains, then it can go at least up to 580, 600 levels, which should be the immediate target for at least a year or so. Hence, every dip closer to this declining trend line, if it sustains above that, is a buying opportunity, decent business. Next talk which I'll cover is Netweb, Netweb technology. So, firstly, what does Netweb do? Netweb do? They have high-end computing solutions, HCS, which they offer. It's a leading HCS provider with fully integrated design and manufacturing capabilities. What all they do? First, they do is high performance computing, supercomputing HPC systems. HPC is high performance computing. Then, private cloud and hyper-converged infrastructure, HCI, they offer that. Then, AI systems and enterprise workstations, high performance storage, HPS enterprise uh, storage solutions, data center servers, and software and services for HCS offering. So these are the six verticals they are in basically. It is India's only end-to-end IT solution provider for high-end computing with design and manufacturing capabilities. It has strong partnership with chip makers like Nvidia, Intel, and AMD, which helps it to compete with global players like HP and Dell. So its competitors are HP and Dell. One should understand this. And it is using the chips made by Nvidia, Intel, and AMD to make the systems. Led by demand for HPC, data center expansion, and initiatives like India AI Mission, it offers a staggering 40% growth opportunity over the next 3 to 5 years. High performance computing remains at a nascent stage in India with strong growth potential across sectors like auto simulation, pharma, drug discovery, and FMCG product R&D. Demand is already visible in research, defense, space, and AI development. Private cloud and HCI, hyper converged infrastructure, are poised to grow at 30% plus, and it offers end-to-end solutions. Servers, switches, software stack, setting it apart. I'll show you later why I'm saying it provides end-to-end solutions. AI systems powered by Netweb's hardware and software and NVIDIA's GPUs are seeing rapid adoption for AI and machine learning tasks. This segment could contribute 20% of revenue by end of financial year 28, which is presently 14%. GPU is graphic processing unit. With no direct Indian competitors, it competes with global giants like Dell, HP, Nutanix, and VMware. Government's impetus on data localization, building LLMs in India, and push for AI sovereignty presents an opportunity for Netweb. It also gets the PLI benefits. So if you see this quarter results, the operating income was up nearly 101%. EBITDA was up 127%. Margins were up 167 basis points, so roughly 15% now. And the profit after tax grew nearly 100%. And EPS is now around 5.38. So, very good results this quarter. For them, HPC, private cloud, and HCI are the key growth drivers for the company, and these are the segments which are taking the revenues up. Strong customer stickiness with consistently healthy repeat revenue share. So the revenue from repeat customers is decent and is around 70%. So the customers stick with them. Revenue is well diversified across multiple verticals. So I showed you six verticals basically, with higher education and research, IT, ITES, other enterprises, space and defense being the critical components. Diversified mix with strong government base and rising enterprise share. So roughly they are 50-50% right now, government and non-government. So they have revenue visibility over a period of time because as I showed you, there is no competitor in India. High performance computing market in India is expected to grow at around 10% CAGR, while AI systems and edging computing market projects grow to around 1.5 billion by 2029. So roughly it is supposed to grow at around 27% CAGR over the next 3 to 4 years. So there where they are strong in this segment. So if you see the revenue breakup over the period of time, the key segments were supercomputing HPC systems, private cloud and HCI, and AI and enterprise workstations, which were the key drivers of revenue. But if you see in this quarter, AI systems and enterprise workstations are the one which are really growing. And so these three are the major contributors of their revenues, while data center servers, software and services for HCS offering and high performance storage solutions is the lower part. But it is in six segments, so that is good. Now, where does the moat comes from? Moat for them comes with designing and manufacturing as compared to Dell and HP. They design, they manufacture, they use these CPUs, but they provide motherboards and software, where others are not able to provide that. And that is one single solution which they are providing by integration of computing, storage, and networking into a single system is where their competitive advantage or moat is there. Focused HPC customization network versus global OEMs is also better for them. Now, clients seeking HPCs, private cloud, HCI, data center servers, or AI systems receive a fully integrated solution. Custom designed motherboards, servers, performance optimized GPUs and CPUs, central processing units, a tailored software stack, and comprehensive AMC support. So this is their competitive advantage, and that's why they are getting repeated clients, or the customer stickiness is there. Now let's see their future guidance. They are expected to nearly double their revenue over the next 2 years. So that is good growth, around 40% plus. EBITDA margins are improving, so roughly they would be around in that 14% range. Profit before tax and profit after tax is also likely to become 2x in next 2 years. So they are expected to grow around 40-45% over the next few years. EBITDA and PAT are also expected to grow. Margins are stable, 14%. ROE is 30% now. They are expected to reach in FY27, which is very strong. And EPS, it is expected to be around 44 rupees in FY27. So that is very strong growth. It is expected to nearly double from what it is today. It is around 20 bucks. So even if this is a slightly inflated guidance. Even if they do 40 rupees, it is good. So at 40 rupees EPS with this kind of growth, you can easily give them a 60 P. So they can easily trade at around 2400. So if you see here, this stock in that last year's frenzy had gone up to around 3000 level. From there, it corrected and came down to around 1300. And now it has risen. And then after the results, it had a breakout. So with large volumes, so it went up to 2300, 2400, and then it corrected based on the correction in the market on Friday. But every dip somewhere closer to below 2000 is a buying opportunity. Don't expect this stock to go to 3000 odd in a hurry, because performance has to be also seen. But if you see over the last few days after May, where the volumes have risen on this stock, and the stock has also improved from 1400 odd now. It has moved nearly 50% to around 2100. So it's a good company. Only thing is that they have to perform. Thank you. I have finished. We'll take questions now.